So let me take this opportunity, although Sunil sir is a very popular name, needs no introduction, but again, in the want of time, let me have a quick introduction. We have had a very good session, sharp session, insightful session 2, 3 months ago, and I'll share the link to that session also. And to our surprise, I mean, no surprise rather, because experience speaks loud than majority of the things. Whatever we have spoken in those sessions are materializing. But again, we'll have a holistic view about the market outlook at this point in time. So, sir brings over 4 decades of experience in the financial services industry in various capacities, be it the public sector banks or private sector banks. And you all must be aware of his stint in Sundaram mutual fund when it was a sub 2200 CR and he has taken it to over 80,000 CR when he retired as a MD in the year 2024. He had worked in various capacity during his tenure at Sundaram Mutual Fund. And in his personal and official capacity, he has many recognitions under his guidance, his name, and also, sir is very keen in promoting financial literacy in India, which is again missing big time. And those who know in the circles of investing communities and mutual fund industry or distribution, they know he's known for demystifying the complex economic and market terms in very simple and lucid manner. In the last session also, we got so many examples wherein the things which appears very difficult for us were brought down to such a level that we were able to understand with great clarity. He has also launched his YouTube channel, and that goes by the name Sense and Simplicity. So surely you must be going and subscribing that channel for his insights, and his media presence are conspicuous. So if you check his handle or maybe any social media platform, you will get to know that sir shares his thoughts on various platforms. So welcome again, sir, and I appreciate if we start with the current macroeconomic environment in India, covering be the growth, inflation, and fiscal stance, and how we can see it can have implications in the market. Over to you, sir. Thank you.
Absolutely. And thank you. And good evening to all the listeners and viewers. So, on a macroeconomic situation, I would say that we are in a sweet spot. And for the reason why do we say sweet spot is, as you know, the macroeconomics are driven by the country's fiscal situation, the fiscal stimulus from the government towards the economic growth, the monetary policy support from the Reserve Bank, and at the ground level, how this translates from both the fiscal and the monetary stimulus, whether that's being reflected in the economic growth. So like I said, we are in a sweet spot because, as you know, our overall fiscal situation has been very stable. For the last decade, we have been following a responsible fiscal management and steadily bringing down the fiscal deficit for our country. So that resulted in Standard & Poor upgrading our economy's rating after a very long period. I think after 18 years, we finally got an upgrade in our ratings. And at the same time, the government has announced fiscal stimulus, both through an income tax cut during the budget as well as the recently announced GST rationalization cut. The Reserve Bank, with the change in the governor, has also announced a very proactive stance with a 100 basis points rate cut, tremendous liquidity infusion, and a support to the banking system through a CRR cut, as well as you've seen multiple reforms to help the banks expand their lending book. And this has been accompanied by a good NPA normalization within the banking system also. So is this being reflected in the ground? Well, until the GST cut happened, it was not truly reflected. We were seeing a K-shaped consumption recovery because post-COVID, the entire recovery seems to have been polarized in favor of the rich and the wealthier getting wealthier. But the poor, while there was an improvement in their financial situation, it had not improved to the level that they were actually willing to consume. So consumer sentiment had definitely got impacted. But I think the GST cut has demonstrated in the festival season a strong rebound at the bottom of the pyramid in terms of either entry level cars, motorcycles, two wheelers, and purchase of consumer durables. So I think all of this is getting reflected. And like I said, for me, from a domestic macroeconomic situation, all of these are positives. But there is one dark cloud overhanging this, and that's the tariff scenario. And this tariffonomics, while we have managed to counter the impact of tariff on our near-term growth prospects, the fact of the matter is, from a longer-term growth uptick from the current 6.5 to 7% levels to a much higher 8 to 10% trajectory, that definitely will get impacted if the tariff situation is not resolved. That being said, there is also one more big word which we need to discuss, and that's inflation. Yes, inflation has been trending down, and so market has been increasingly building up future rate cuts by the Reserve Bank. But I would like to throw a cautionary note here on the inflation. While from a consumer perspective and from a Reserve Bank's perspective, and the fiscal deficit perspective also, lower inflation is good. It's not good from a healthy company's earnings growth perspective. Why do I say this? Is because ultimately low inflation hurts rural India. Because rural India is dependent on food prices going up and their profits or cash in hand going up. So a sustained period of low inflation, and this has happened in the past, way back in 2017-18, there was negative rural inflation, which led to a short-term downturn in the economy, and the markets also reflected that. Similar situation here is that because of this, if you see the latest GDP number, for example, everybody was celebrating a 7.8% quarterly GDP growth. But what was hidden behind those numbers was that we only had an 8.8% nominal GDP growth. So my thing about this is that it's a slight bit of a red flag because corporate earnings track nominal GDP growth, and that's why the stock market generally beats the nominal GDP growth over the medium term. So this fact that the gap between nominal GDP and real GDP has been compressed, and we only had a 1% addition to the real GDP and the nominal GDP, means that corporate stock market earnings will also reflect a slightly lower growth than if inflation had been higher. And this, why do I view it as negative? One is corporate earnings are ultimately marketed as a slave to earnings. I know you asked me only about the macroeconomy right now. So when we discuss the markets, I will bring this to the fore in terms of the future expectations. But that being said, if it leads to a rate cut, there could be a definite improvement in the market sentiment in the short term. So I think overall, like I said, macroeconomically, we are on a reasonably good and strong wicket, barring this one tariff overhang, which obviously impacts the export sector to a great deal.
Great, thanks. So, sir, if throw more light on how you see the liquidity over the at least say next 12 months, and also some thoughts on the global economic slowdown in parallels with the US and the other global economies.
Sure. See, from a domestic liquidity perspective, I think RBI has been very proactive in terms of pumping in liquidity, right? And especially this has also happened because despite the FI outflows, RBI has not defended the rupee much. They've allowed a 4 to 5% depreciation of the rupee. So which means if they were defending it, then they were more sucking out of liquidity would have happened. But RBI has been conscious that allowing the rupee to weaken is also a counter tariff proposal from our side. So they've used that tactic. And second, sucking out domestic liquidity to protect the rupee would have meant further, hurt on the domestic side. So I think RBI has played a nice balance there, and hence I don't see a challenge around the liquidity because until this tariff situation is resolved, a weaker rupee is more supportive in a tariff situation. So I see that domestic liquidity will continue to be reasonably strong, and RBI will continue to support it. Now, from a stock market liquidity perspective, it's a different issue, right? Because domestic liquidity in the stock market, thanks to the growing SIP book, will continue to be strong, no doubt on that. But FII liquidity for the stock market is going to be a challenge until and unless the tariff situation shows some improvement. So in context of that, and you move to a macroeconomic situation, yes, the biggest thing to look at from a macro situation is the impact of the tariff on the US economy, because I saw a study which said that 52% of the tariff impact was absorbed by US companies, and another 30% by US consumers. So clearly, and then there is a Supreme Court challenge of the tariff situation. It's a challenge not on the tariff imposition, but on the rules, on the reasons used by the Trump administration to impose tariff, which is invoking of emergency powers. So that's being challenged in the Supreme Court, and the news is that that it could be a negative verdict. But that being said, Mr. Trump will find another way to impose the tariff. So let's look at the tariff as something that will continue. It may see a short-term reaction from a Supreme Court decision to do that. But that apart, the tariffs impact clearly then the profitability of US companies, and the second thing is of course US inflation. So a Fed rate cut to boost the US economy in the context of the slowdown that's being seen there will be hampered by the inflationary situation. Though, of course, the US has a view of a third index which they look at, which is the employment index, and there I think it is supportive of a rate cut. But all of these are indicative of a situation of a slowdown in America. But the worry is not just about a slowdown, it is that if inflation is not going to come down and there's a slowdown, then you are looking at a stagflationary scenario, right? Because that doesn't give a clear-cut direction to the Fed on how to handle the situation. Because a rising inflation prevents rate cuts, and the unemployment and the slowdown supports a rate cut. So there is a kind of a logjam, and so Fed's thinking is going to be very crucial to watch out for. So if the US is going through a stagflation kind of a slowdown, its impact will be felt on the rest of the world. And I know that the US and China have recently patched up, put on hold their tariff war for a period of a year, with China agreeing to buy soya and corn and maize from the US, putting a hold on its rare earth exports there. So there is some kind of a truce there. But a longer term one is bear in mind that China is also dependent on the US from a growth perspective. So if the US is going to go through a slowdown, then we are going to see the impact spill over on the Chinese growth and hence the world growth. So the slowdown in the world growth, however, from a market's perspective, is not necessarily a very bad thing. The reason being that, as you know, the US stock market growth has been a very polarized, tech-driven, AI-driven growth. The broader US stock market is reflecting the pains in the economy. So from that point of view, I would say that there's more likelihood of I know the quantitative tightening is to end by December 1st, but if this is the situation panning out, that might see a delay. You might see increasing liquidity being used as a tool, and that liquidity will then spill over to emerging stock markets. And so you might actually see the stock markets get support from a liquidity perspective, right? And not necessarily from an economic growth perspective. So it'll be interesting to see how that situation pans out. And what's hurting all of this is that 58 days slower, the shutdown of the American economy, because of which data is not available to the Fed to take a more precise and accurate decision. Because you're not getting labor data, you're not getting housing starts, you're not getting critical data for decision making. So there is going to be a logjam in decision making that it's like, I think Mr. Powell clearly said, it's like driving in a fog. Your car doesn't have visibility, your headlights don't work, so are you going in the right direction? So thus, uncertainty around even the Fed's ability to act is going to affect it, but overall, it would probably increase the need for liquidity support, and that spillover to emerging markets, stock markets, and to perhaps to India might be a countering force to market performance.
And there is also, sir, chatter about the cryptos being used as a tool to taper down the US debt. And also, we have seen the rally in the gold and silver and the kind of talks happening. So, broadly, what are your thoughts? I mean, is there something which we as participants in the market missing, or it's a common scenario that happens time and again?
No, I'm not sure that it's a regular, normal phenomenon. What's happening now is a very special situation. And that's because of, I would say, an increasing degree of lack of trust and a lack of confidence in the US by the rest of the world, which is what is reflecting in this shift to precious metals and to some extent a shift to crypto in the rest of the world. In the US, usage of the crypto to substitute that debt, I think that that's a very bold step. I don't anticipate that will happen. There's also another talk, which though you didn't mention, I will mention, of revaluing US's gold reserves. to kind of tackle the deficit. Now that's just paper accounting, right? It's not real wealth creation. So I would say that yes, I wouldn't put it past the Trump administration to try either a crypto or a gold revaluation to try and address the the debt situation. Yes, that's a possibility, but it's not very positive probability because it means you're papering over the cracks and not addressing the core issues. So let's wait and see how that decision pans out. But on terms of the precious metal scenario on gold and silver, like it's what has changed. India has always been the highest buyer of retail gold in the world. That is continuing. Nothing changed there. What has changed? And it's not just these wars like the Russia-Ukraine war or the Israel-related wars on Hamas or on Iran or whatever. That's not that is normally a positive for gold, but this time it's much beyond that. This time it's a strategic reallocation of reserves outside of the dollar, triggered by the way America froze Russia's assets post the Russia-Ukraine war. And with the trade war being another kind of a war, the dependence of a lot of foreign exchange reserves of a lot of countries on the dollar is huge. Japan has more than $1 trillion in US government debt. China has 750 to 800 billion dollars. So what's happened is that they are worried about multiple things here. One is Trump likely to use the dollarization as a weapon of freezing dollar assets, even let's say in a war, trade tariff war versus China? Remote possibility, but still something within their mindset. Second, if the US is actually going through a slowdown and then the Fed has to do a rate cut, it means that the dollar is going to weaken. If the dollar is going to weaken, then the value of those reserves is going to be a challenge. So that's the second worry for these sovereign wealth funds. Third is that they're using these sale of the dollar to buy gold is also a weapon against tariff. It's a weapon to US to say that, hey, I hold so much of your debt. If I start pulling out my money, I'm going to. So it's a leveraging tactic. It's a negotiating tactic by China and to some extent by Japan, though not overtly stated so, right, against the dollar. So in a sense, this move to gold and silver is part of a larger de-dollarization move of less reliance. And that's because Mr. Trump, I think, has also harmed the trust that was there in the US, that the US would be the ultimate safe harbor for the world, that they would support. But the US has been acting in a very, I wouldn't say selfish, is an extreme word, but MAGA is that my American interests are first. So he has withdrawn support to the WHO. Right now, he's not going to participate in the next G20 because white farmers are getting affected. He's talking about war on Nigeria because Christians are getting hurt. So the US is behaving in what I would say, very different. It's not a more realistic world, but a more self-centered world. So that means to that extent, the rest of the world is also losing its trust gradually on the US and consequently on the dollar. So I see that this move to gold and silver is something that is more sustainable and going to sustain. May not replicate the 50% returns that gave last year from next year, but definitely a double digit level of appreciation in gold and silver as not only as precious metals and safe harbors, but as physical assets which don't lose their value. So this shift from financial to physical is also part of this world preparing itself for something getting tougher with the US, right? So they are insulating themselves. So I see that as a sustainable and yes, the world did miss it. The financial markets missed it. No fund manager worth his salt was recommending taking gold exposure a year ago. Today, if the situation is different, and I would say that multi-asset allocation in terms of keeping precious metals also at a maybe whatever depends on 5 to 20% depending on your aggression and your risk outlook as part of your portfolio makes sense because these are deep underlying forces which are multi-year thought process outlook. Now, is Mr. Trump going to turn turtle and suddenly go and be friends with the world and do happy nothing? I don't think anybody's expecting that. So as long as this, and I would all point it down to ultimately a four-letter word, that the world is now factoring in a Trump uncertainty risk premium across everywhere. And that's reflecting in the appreciation for gold. That's reflecting in some extent in the stock market reactions and the rest.
Perfect. Thank you, sir. And sir, we have spoken about the valuations in the Indian equities last time.
Yes.
So any change in view from there, or we are more or less placed over there on?
No, I would say that there is some improvement in the scenario there. I think last time, compared to last time, I think it was pre the Modi announcement on the Independence Day, right? So
Yes.
since then, I think that obviously the GST cuts have led to a boost in the consumer sectors, especially auto and consumer durable parts. And I see that as a sustainable phenomenon right through next year because I see another wave around auto around the JFM quarter because of the year-end depreciation for buying vehicles. And then I see the summer being driven by a cooling related consumer durable growth, all relating from the GST cut and the EMI cuts. And then the last leg of this rally I see playing out in the real estate sector because ultimately rate cut and even the real estate related sectors have seen some GST cuts. So there is a favorable price movement which will be happening there. And I expect that now affordable housing should show a pickup in about a year because there is also a supply issue in addition to the demand issue in affordable housing. Earlier there was a demand. People at the bottom of the pyramid were not buying houses despite all the tax benefits that the government was offering there. But now the fact that that demand is likely to look up means there's been a supply issue because builders haven't been focusing on affordabilizing and there isn't enough supply. So over the next 6 to 8, 9 months, I expect builders to go look for parcels of land and put their plotting and flat promotion according to an affordable housing market space, and that should be the next leg. Along with the in the corporate world, the GCC growth I think has been also been rapidly expanding, and so the real estate sector should show a good with a lag there. So those will be positive for the earnings on the broader consumer related space. I see the banking related space because of the RBI governors. Multiple levels. If you start dealing with that, I see at least 15 steps that the RBI government has taken, which is positive for the banks. On top of which comes the news of government in the PSU banking sector, talking about two things. One, increase in the limits for foreigners to invest up to 49%. The second, there's talk about mergers. And this time the mergers are going to be slightly different. Normally a merger is done basically because there are a lot of weak banks in order to shore up their capital adequacy and help them. The larger bank can merge a weaker, smaller bank with it so that the overall banking entity gets the benefit of the larger enterprise. This time around, the mergers are probably going to be about two similar sized, good quality banks merging because the focus this time is on making them international scale so that not only will they attract FDI stroke FII interest in their shares, but also in terms of borrowing, they can go and borrow in the international market, either dollar-based loans or rupee-based masala bonds to raise money and not necessarily depend on the Indian domestic scenario for financing. So that I think is a big, big uptick. So for me, I see that this second quarter earnings has been mixed. I do expect maybe a 7 to 8% earnings growth, but it's also the turnaround quarter because this quarter saw only 7 or 8 days of the consumer boom play out. So October, November, December quarters results which come in January because these consumer discretionary related plays are all highly operating and financial leveraged. So they have a high fixed cost. So all the top line growth which has happened this quarter should hopefully reflect in a good margin growth unless they have sacrificed their margins in the competitive world, which we'll know only when the result season comes. But I'm optimistic that that earnings season growth we have bottomed out and we are now looking at a much positive second half, which should see a double-digit earnings growth. So from that point of view, I think that even if FIS don't come back, I see that over the next 6 to 9 months, a 5 to 6% appreciation purely by an earnings upgrade related situation in the market. And if the FIs come back, then you can even see double digit earnings growth. But the FII comeback is essentially not so much driven by any domestic situation. I think they are very comfortable with the way the domestic economy is growing. For them, it's a tariff which is hurting India's future upscaling of growth. And so any resolution on the tariff front would act as a trigger for an FIH to come back to net positive on a sustained basis, which could take the markets even higher. So yes, from an earnings growth perspective, I feel that this quarter is probably in the bottom. We'll see a much better outlook for the second half and for the next year.
So, any pockets or sectors to your mind, sir, wherein you find excesses and maybe at this point in time they doesn't appear to be that much suitable in comparison not to the other sectors, if you want to highlight a few.
See, because I think the pressure on a lot of say sectors like defense and power and all of that, you see, I see that their valuations are quite high because there's a huge growth prospect built into the current valuations. Now, the fact is, those growth numbers have to happen for those valuations to be justified. So I would say that the margin of safety in those sectors is less. Yes, the growth can happen and justify the valuation growth in a lot of public sectors, apart from the PSU banks. A lot of public sector enterprises also I see as quite rich on the valuation front because a lot of government order book flowing through to them, the railways and the power and to the defense sector has been factored in. So I think that's the sectors which have shown that and I think that the expectations are very high. So to some extent, I would say you could see that domestic liquidity, because it constantly seeks value, could see profit booking in those sectors and rotating into the underperforming sectors. That's number one. And especially this profit booking will be triggered when and if a tariff situation is solved and the FIs come back, then you will suddenly see that export-oriented sectors which are lagging will become the flavor of the month. Now, in order to buy that, there is a certain amount of SIP-related liquidity coming into mutual fund managers, but that won't be enough for the kind of buying they need to do. So they will necessarily rotate out from where they have made good money into these sectors. So sectors which have had a good decent run up, right? I mentioned two of those. The other one is in fact even say an auto has had a good run up in this post rally. There could be some profit booking there. So I would say that a lot of our valuations are on future growth discounting. So the key thing from a valuation perspective is your margin of safety is higher where there's been a correction. So if you take a 1 year return comparison of the Nifty versus sector wise, you'll see IT, consumer durable, despite this recent rally, FMCG and realty are the ones which have underperformed. So I would say that the margin of safety is greater because like I said even realty with a lag will pick up. So my point of view there is not to just say recommend you to go and look at these from a contra bet, but to tell you that fund managers will look at these from a contra bet because one tariff situation coming and changing, they will need to go and buy those which have been ignoring so far, and that will mean that sector rotation will be happening. So that's what could limit an overall market's appreciation, but sector specific, there will be a lot of reallocation happening. So that's the key thing I would say to watch out for, and not so much a concern on any particular valuations so much as that sectoral rotation by the fund managers leading from coming from a profit booking perspective could lead to some sectors not performing as well as is there in the price today.
And sir, if we talk about debt funds, so what would be your outlook? And if we were to ask you any round off number, if somebody has to invest today, so what would be the number between the equities and debt basis the scenarios?
See, given the fact that equities have not had such a good year, right, I would say next year is a time for a bounce back because I think sooner or later the tariff will be resolved. I can't put a timing into it, but if you're taking a year's outlook also, I would bet that the tariff situation will see a positive development in the year's time frame. So to that extent, I will say is that the outlook for equities, right, is better than it for last year. And in the case of debt, I think a lot of the rate cut and everything has played out. I think a further degree of rate cut to expect from India. Because remember, when Indian economy booms, it needs a healthy rate of inflation, as I told you. So to some extent, I think we are nearer the end of a rate cut cycle from India perspective, the US may go on that path, right? So to some extent, I would say that your debt related allocation will give you a high single digit yield in the coming year, but I still expect equities to deliver a good double digit return. At the same time, I also mentioned that precious metals also should yield a good double digit yield. So from that perspective, from a reallocation perspective, I would say putting about 20 odd percent in debt, putting out 20 odd percent in your precious metals related sectors, and the balance 60% equity would be a good way to play the coming year.
Perfect, sir. And sir, one question, although not that technical, but say since we were seeing a lot of discussion about the Lenskart IPO. Let's not take Lenskart in particular. IPOs come and go, and the valuations are always debated, and people also go check the anchor list and talk about X mutual fund has participated, Y has not, and they come up with moral policing and whatnot. So ideally, what we as a retail investors are missing in those scenarios, how we should be looking at IPOs in such scenarios or in general to say.
So I would say I'll put this as a two rules. Okay. So one is a new age company with limited existing competitors listed in the stock market. And second is IPOs which are coming from well established old world regular models, where there is enough competition already listed in the stock market for a new entrant to be valued properly and judged, right? So IPOs come from both spaces. So on the existing IPO, those which are coming in industries already present in the capital markets, right? I would say that I would look at from an IPO, from a retail investor perspective, look at only two things, right? One is that no, I mean the valuation and all that you leave it to the anchor book people to go and decide the book building and all of that. But what is the end use of the money, right? If that money is being raised from the capital market for reinvesting in their business or to pay off debt which they used to grow their business, great. Subscribe to that IPO without any thoughts. But if it's being used by the existing promoter to dilute his stock saying valuations acha paisa ban raha hai, let me take out my money, that's a negative for that company's business, right? If so that, yes, a venture capitalist which supported, but that's not there so much in the old age companies. But if an initial private equity venture capitalist had supported it and is taking a takeout, that's okay. Because that's what he took the money from his investors to put in to book profits. That's fine. But the actual promoter running the company, if he is letting go of his stake, it's a warning signal for me. And I would say that those kind of IPOs, you should stay away. This is on the old world IPO. Now we come to the new age IPO. In the new age IPO, the reason these valuations, everything, because nobody has a model to model the new age. Because the new age, first, there isn't enough, even if there is an existing listing of one or two companies from that sector in the new age space, they are also already at high valuations because the whole place is a discovery space. So people are trying to compare this to the dot-com boom and say that is this a bust coming to happen? I'm not agreeable with that. I think the future is very good. But yes, has the market got the pricing right or not? You cannot know until the future develops. So my suggestion there is that for people who are, and all these new age companies are betting on what? India's demographic dividend, the youth and the country is going up. India's changing internet dynamics, the penetration, the data, people's awareness of everything about internet and everything, and all of those things, right? The socio-demographic change in India. Now that's definitely something which was not there in the past, which is there in the future. So the outlook is very promising and very good, right? The point is, what is the right price there? There is no right price. What the market decides is the right price. It's just like crypto. It's just like gold. There is no underlying value to gold. You can't do an earnings growth on gold and say this is the right price. Gold has a price. Is there a value to gold? You can only look at it from a technical and average, say, 10-year average it has crossed or something like that. But there is no true value to gold. Similar to that, in the new age companies, the true value lies in the market expansion, in the phenomenal growth that the future provides, which cannot be judged. Now, what is the other issue here? First is the valuations can't be, realistically computed using a discounted cash flow model because most of these companies don't even have cash flows. Some of them making losses, some of them just made profits 1 year back, everything. But the second issue is the high failure rate of these companies because they burn a lot of cash, but we don't know whether they will succeed. The sector will expand. They will in fact contribute to that sector and the business expanding, but they may not be the winner. The winner may be another competitor who's managed his business much more smartly, timed his entries and exits perfectly, and all of that. So my suggestion here is that to somebody who's willing to take that risk bet. So first of all, as a customer, you should have that riskiness. Second, do not look at these new age IPOs from a listing gains and I'll exit on listing. That's a trader's mentality. I don't have any answer to that. But if you're an investor, and you want to use the IPO to look at it, by all means apply to all the new age company IPOs. But I have a provision there. First, your risk level, you must be comfortable with a high degree of volatility. You have seen from the past new age companies how volatile have been their next 52-week performance. The highs and lows are tremendously varying. So what I say is that, look, these businesses as sectors are definitely winners. The companies within those sectors which are going to be winners, we don't know. And what is the right price, we don't know. So the best way I would say to do it is allocate an X proportion of your capital for the new age sector. Okay. I would say keep 25 companies in mind. The reason for choosing 25, because ultimately I'm driving at the fact that diversification is the best, right? So beyond 25, fundamental capital market research tells you that the diversification benefit vanishes gradually after 25, right? So 25 is an optimum kind of a diversification pool. Number one. Keep 25 companies in the radar. Don't look only at the listed companies today. Look at the listed companies today. Look at the to be listed out in the public domain and look at those which are nowhere near listing but can list in the future but are competitors in this place. So build up a data book of maybe 40 to 50 companies. Now out of that, today you choose 10 or 15, right? Which will be either you're buying the stock of the new age company which has just got listed a few weeks, months, or maybe a year ago to buy some stock of that. Second, subscribe to the IPO. As it is an IPO, is a lottery, you don't know what you're going to get. Subscribe, apply to the IPO. But still keep it, overall the company is only at 10 to 15. Keep a balanced 10 company cushion in you for the newer companies going to come and list and you're going to apply either in the next 3 months, 6 months, 1 year, whatever. Keep that in your concept. Second aspect to it. So clearly you're going to have a diversified pool. That's critical. And why the diversified pool? Because you can't predict the winner. The best fund manager in the world cannot predict which of these companies will be the winner. Go back to a year back and 2 years back and see what people, for example, Zomato and Swiggy. I'm not saying anything, but if you ask the fund manager to poll saying who would be the winner, there would be one answer. Today there's another answer. I'm not saying this is the winner, that is not the winner, but two exactly the same companies, same thing, nobody can predict it. So diversify so that you win in the space, but not necessarily through the company betting on that company. Second point. Third point, just like you do in a mutual fund through SIP, why? Because you want to take advantage of rupee cost averaging. The volatility in the prices, you want to turn that to your benefit. Similarly, in the new age sector, this initially you already chosen 10 to 15 companies, start a stock SIP in those very companies. Keep buying little of the stock right through the year because then their volatility will come into your aid. And similarly, when the new IPO you do, you are subscribed to the new IPO, whatever you get as allotment, post listing, keep buying that stock every month, little by little. And like I said, keep enough reserve cash for the futures to come. Don't burn off all your money here. So I would say roughly 60% of your capital you can deploy today because the journey of that has already started. The balance 40% of your capital for the next 10 companies, right? I'm saying 15 companies now out of the 25 pool. Next companies you buy over the next couple of years, but follow this philosophy. And all of these companies don't panic at the middle stage and sell out. Because, like I said, these companies go through that cycle of discovery. We don't know who will be the winner, and there will be mergers and acquisitions happening, which could transform their scenario. So, sorry for a fairly long-winded answer on this IPO question, but I think that's the best way that you play the risk-reward game in the new age business. Because if you ignore it, that's a greater risk than if you participate in the manner that I just said.
Perfectly explained, sir. And since we are talking about the mutual fund, then say mutual fund industry trends basically. So, be it the SEBI new regulations, maybe the disclosures, expense ratio caps affecting the mutual industry's growth and profitability. Also, you'll see I mean, the increasing dominance of passive investing, ETFs, and index funds. And also, sir, would appreciate your views, like how you see the fintech and direct investing platforms changing the traditional distribution model. So some thoughts in these mutual fund industry trends would be helpful, sir.
So first of all, I think that SEBI's is a well thought out regulation on the consultation paper part. where I think some of the clear thought process have come through, which are all in favor of either reducing investors' costs or on increasing investors' transparency. I don't think SEBI is concerned about the viability of any of the stakeholders in the industry. There for them, the investor is front and center, both in terms of cost reduction and in transparency. The cost reduction reasons come through because the industry has scaled tremendously, and I think they feel that the scale benefits have not adequately been passed on to the customer. So I see this as a continuing trend. This consultation paper is not the last part of it. Over the next year, 2 years, 3 years, you'll see further attempts to reduce costs and bring that benefit to the investor. So, and that will going to definitely be playing its part in expanding the footprint of the mutual fund industry, which even today is abysmally low at just 5.5 crore unique PANs in a 140 crore population. I think so. That's it. So, but that being said, right, what I see the consequence of this cost reduction that's happened is that it's also overblown. Yes, there is a 5 basis points exit load cost which has been taken away. So that's a 5 basis point hit to the overall ecosystem, which will be shared between 4 players here. The 5 basis points cost itself will be listed AMCs in one way, non-listed AMCs in another way, listed large distribution in one way, and non-listed small distribution. So the smaller non-listed AMCs and the smaller non-listed MFDs in the country are the ones who are going to take the brunt of this 5 bips reduction. The larger distributors may get away with no reduction to their trail commission, and the larger AMCs will look to pass it on because once they are listed, they suffer from the kayamat se kayamat tak, quarter to quarter say quarter tak. They have to keep showing their profitability and all that growing. So they will definitely pass on this as much to the distribution on the 5 bips part. Now on the other thing, which is the 15 bips reduction, which has come in the expense ratios, it is just but an accounting turnaround. It's not a real reduction. I'll tell you why. The reason SEBI has brought that down by 15 bips partly is due to wanting to pass on some cost savings to the investor, but the real thing is that they are removing taxation from inside scheme accounting to outside scheme accounting. So what happens is that now, for example, asset management fees, the GST on that was already permitted to be outside the scheme accounting. But a whole host of other expenses, distributor commissions, R&T commissions, other expenses which were to be paid from the scheme, not from the AMC's books, they were not getting the GST benefit to the suppliers of those, whether they are mutual fund distributors or R&D suppliers, because since it was within the scheme, if you then account the GST, the AMC fees would have come down. So the industry never gave the GST benefit to the distribution. So what happens is SEBI brought this down because if you, as a consequence of this, the savings in the taxation which was earlier going into the scheme now going out, then if you had left the expense ratio slabs at the old, AMC's profits would have just shot up to that gap. So clearly they said, no, I'm saving this part, so I will reduce the TR. So it's just an accounting changeover. I don't know how many people understood what I'm trying to say, but I hope they got the gist that because they're removing statutory levies from within the scheme to outside the scheme, right? That additional space created, they have crunched back the space so that ultimately things are back to square one. They are hoping that some cost benefit will still translate to the investor. So from the investor perspective, they shouldn't look at that 15 basis points going to be the reduction in his costs. Because 15 basis points, the base TR will come down, and then base TR plus taxes will be the ultimate cost to the investor. That's why SEBI also is clarifying from a transparency perspective that what was earlier known as total expense ratio, they have now removed that word to say base expense ratio plus taxes. That will be the total expense ratio. And that is not specifying because taxes can vary. GST is currently at 18% for the industry there. Who knows, the next range of GST reforms could bring that down to 12. That will be a benefit, will then go straight to the investor. Whereas if not, if the GST had been reduced, it would have simply gone to boost the profits of the AMC. So SEBI wants to do this both from a transparency and ensure that any future GST rationalizations on taxes comes as a benefit to the investor. Right? So that being said, that there's another leg of this which I have not covered, which is the purported move to cap the brokerage, which is paid to stockbrokers for execution from the earlier 12 and 5 basis points levels to 2 basis points. Now that is one that is being requested because there is still a consultation paper. 17th November is the deadline. the top stockbrokers and the AMCs have gone back and said, SEBI's view was, look, only for execution for arbitrage and derivative trades, you're paying only 1 to 2 basis points. Additionally, you're paying for research, but anyway, you're taking asset management fee as a research. Why are you double charging the investor for the research by giving this also? And mind you, that brokerage expense was entirely outside of the TER. So the old TER, total expense ratio, was absolutely misnamed. It was not total by any means because there was brokerage up to 12 bips outside. There was AMC fees, management fees which was outside. So it didn't mean total in any way. The actual expenses charge incurred by the investor was much, much higher. So what they said is what will be charged outside. Now I'm limiting it to 2. Now everybody is jumping to it to say that, oh, that means how will stockbrokers be able to service and provide the research? What will happen is that obviously there is a tug of war between the AMCs. Now, SEBI didn't say don't pay more than 2. SEBI has said that 2 is what you can pay outside the base expense ratio. If you want to pay more, let it come from your revenues. So that's where the challenge lies, because obviously these stockbrokers are providing good quality research. No AMC wants to do away with that. It's because not just on the Indian stocks, it's because it's also on international stocks they advise. And not only that, is that there are more than 4,000, 5,000 listed stocks. And AMCs, would like to research everything, but they just don't have the adequate manpower to, except for a limited set of, say, 100 stocks, they can't really go deep and wide in terms of coverage. So these sell-side brokers, as what these brokers are called, provide very valuable research inputs, which you can't do without. So the only thing is that AMCs will use this to negotiate that down, saying, hey, now it's coming from my bottom line and not from a customer cost, so I can't pay you that much. So I think both AMCs and the stockbrokers will make the representation because everybody can through the consultation paper, and informally also they may raise it up with SEBI, and SEBI may revise this to 3 or 4 or 5 maybe. But all my point is that ultimately, so this may affect AMC profitability, but if you look at the overall pool of things in terms of the bargaining power, right, I would say that the listed AMCs would even take this and pass it down to other service providers, partly the broking companies. So if you are paying now, see, this 12 was never anyway paid in full in 12 by the bigger AMC. They were paying 5 to 7. They may bring that 5 to 7 down to 4 to 6. One part cost will be taken by the broking companies. 1 or 2 bits they may take in their AMC fees, but R&T charges, because they're also getting the tax benefit now of the GST outside, and they can claim input tax credit. They will try to reduce that. Similar with the distributors also, because they are getting the GST benefit separately now, they will try and reduce their brokerage a bit. So it will be a shared cost. But to summarize then, I don't see that. I know that the market has not taken positively to these large listed companies post this consultation paper, but I think that by and large they can manage with the cost there. The people who will bear the brunt, unfortunately, are going to be the small AMCs, the small distributors, small AMCs, because their bargaining power will be very limited with the distribution community or the broking houses. The small listed, so unlisted distributors, because they don't have that collective bargaining power. So the larger ones, either those who have a big sub-broker model or their own bank distributors or something, they will drive a hard bargain. So they will also manage to get away. But the smaller mutual fund distributors are probably ones who are going to take the brunt of any of this cost rationalizing that happens. But like I said, because of the GST impact, that impact will also be lessened, and it is not as frightening as it looks, saying, oh, 5 bips cut there, 15 bips, 20 bips cut in my trail commission. No, it will not be that bad. On a post-tax basis, when they get GST input credit, it will not look as bad. And overall, I think this is something that the entire ecosystem, which is stockbrokers, asset management companies, listed distributors, and smaller distributors, all will share the burden and it will be easily absorbed. So, but overall, because it's going to be an ultimate net cost reduction to the investor, probably it's something that will boost it. You mentioned here to me about Zerodha and the other stock direct kind of a distribution which is coming on. See, the value of advice, I think, will still be very, very high, because there's a plethora of new AMCs now coming on board. Lots more fund offerings coming from new products like SIFs have been launched. So I think the world is also moving to a clear demarcation that a sophisticated investor or a trading oriented investor can use these platforms to do that. But for the large mass retail people, they still need advice on goal planning, financial planning, asset allocation, all of which only the distribution community with a personal touch can provide. Technology is good for execution. Technology is not good for advice. You can't have pre-packaged solutions which can be just floated out. Each customer is unique. Each customer's risk appetite is unique. Their goals, their time frames, their dependent, how many people are dependent on them. How do you plan for that? All of this is a huge exercise. Very few people can sit down and do. They have their own day jobs. So to say they can decide to go buy a stock. So these platforms will help for hot button kind of action. Oh, I want to buy a mutual fund, sell it in 2 months, change over to that sectoral fund, change in 2 months. Those kind of a volume-based transactions will naturally, these people will dominate, right? But the hardcore job of wealth creation, I think that will ultimately vest with the distributors, because ultimately this is about risk assessment, about a trust-based relationship, and about planning a goal with an ultimate end goal, end result in the future, which I think is where the distributors play a very important role. And I don't see that as going away, because as a country, you mentioned that I'm in financial literacy. Financial literacy is so low and abysmal that the value of advised distribution, whether it's through RIA model or through a MFD model, I think is absolutely critical and is here to stay. And yes, with these challenges in terms of costs coming through because of this regulation, scaling is very, very important. So at the smaller end of the MFD chain, right, I do see increasing mergers, acquisitions, and scaling up either through the sub-broker, becoming sub-brokers model, that increasing in its intensity, because ultimately this now becomes a scale game, because your profitability in terms of trail commissions is coming down. The only way to make your profits also to grow is to build scale, and scale is coming from two places. One is deepen your share of the customer's wallet, multi-product solutions to the same customer, and to add new customers, because like I said, penetration is still very low. So overall, I think that each of the players has space to grow and survive, because we are a very young nation. So there are people who will experiment with the newer age models and robo advisories and algorithmic trading and allocation, and all of that will come, but each will have its own space. But the need for advice in a country where financial literacy is very, very poor, I think is absolutely not negotiable and is here to stay.
Perfectly shared, sir. So, if we do not talk about investor behavior, that would be a disgrace to our participants. So, investor behavior is something, sir, which is paramount, and time and again we speak about it, and especially in the market which are sideways, or which bring fatigue to the investors, in the sense they do not see so much of price action, or the company is doing well. So what would be your advice sailing through these volatile times, or maybe times wherein market isn't doing anything? How is best approach, or maybe, I mean, too broad a question, I understand, but to summarize, it would be great to have your views, sir.
So to me, I know when you use the word investor, I think it's very loosely used, because you have traders also classified as investors, and you have investors who are investing with a purpose and a goal in mind, right? So to the traders are the ones who get worried with this, the fact that the stock is not moved anywhere, the market has not gone anywhere, it's all sideways movement, consolidating market. So yes, traders will be disappointed with that kind of a market, because their opportunities are that much less. And to them, my only advice is, trading is a portion. It's a emotional need or something that you do. But if you're looking from a trading from a revenue generating profit model, SEBI studies are ample to show you that more than 90% of individual stock traders or F&O traders don't make money. So the house always wins. So trading, I understand there's a need because of the youth and their ability to want to dabble with risk and experiment with risk, and in a way gamble with that risk and win it off. So it's a part of that emotional journey. Whatever amount I advise, I give anything, is not going to cut any eyes with them. They will continue to do what they're doing. So that's where it is. But if you look at a person who's coming into the stock market with an investment perspective, with a wealth creation perspective, which building for future goals perspective, there are two, three things which I would like to tell them. First is the basic mantra of the market is buy low, sell high. And I know this is like very flippantly used, oh, buy low, sell high, to kehte jayenge ab. No. Why I'm saying this is that every investor should actually seek and desire a correction in the market in the near term so that he can profit in the medium term. So people have the opposite view. When the market is booming is when you want everybody to come in. Already prices are running up, you want to enter in. That's where I'm saying it's a mental challenge that you should welcome this consolidation, because that's, if you've heard this current speech of mine itself. Macroeconomically, India is doing fabulously. Everything is good except for that one T word called tariff. Everything else is fine. The markets aren't going anywhere. Why? Because though FIs are selling because of this T factor, which is dominating, in my opinion, domestic liquidity is supporting. So actually market should have corrected much more if not for this domestic liquidity supporting the market. So you're today in a situation where things can't get worse because domestic liquidity, unless the market goes through a correction, is not going to vanish. It happened in 2008 when after the boom, the second half of 2007, you had, market crashing and people who burned their fingers didn't come to the market back again for another 3 to 5 years. But you're not going to face that situation now. Why? Because India's macroeconomic fundamentals are good. Second, most of the fresh investments are coming through SIP, which is a systematic monthly paying. So market's not going to suddenly dry up from liquidity. And hence, in the absence of such a great crash, despite such a heavy amount of FI selling, means that we have now a stable base. Now things can only get better from here, like a tariff resolution, the return of the FII. So today is a golden opportunity for you to buy near low. It's not buy low because the markets didn't correct as badly with the FII selling, but at least it's buy near lows, and the future from a medium term perspective is only going to be higher. There's no doubt about it. So my first thing to these people is view the current set of sideways movement and consolidation as a clear indication that the market doesn't have the ability to correct deeply because of domestic liquidity, hence is safe enough to buy. Because otherwise in a falling market, people will always say, why not I buy tomorrow? Because if tomorrow is going to be worse than today, then I would have bought even lower. Today, unfortunately, that situation is not going to be there. That market is going to be much significantly lower. Yes, a 500 to 1,000 point correction in the Nifty can happen, but that's neither here nor there. When a Nifty running around 26,000, in a medium term time frame, you got to think of the Nifty at hitting 50,000 or a lakh. So in that context, whether you buy 26 or 25,500 or 26,500 doesn't make any difference. That 1,000 point move this way, that way is of no relevance to your medium term goals. So that's number one. So number two aspect here, which I also want to point out to the investors, is that every single investment, including an SIP, but the SIP, there is the start of the SIP, or every single lump sum investment you do must be done with a predetermined, prefixed goal. Why I'm saying this is, many people have seen many booms on paper wealth, and then there has been a bear market and a bust, and that money has evaporated. And when they wanted to do something in the money, the market situation is not supporting them. So the only way is people don't know when to sell. They keep consistently buying, but they don't know when to sell from a medium term investor's perspective. So you fix a goal for each of investment. It could be a very small minor goal. I want to buy a bike, I want to buy a Harley Davidson, or I want to buy a X car, or Y, a holiday, something in the distant future. Obviously not something that I want to do this next week or next year. It's got to be a medium term goal. Link that to that investment. Because when your investment grows to a level where that goal can be achieved, you ruthlessly redeem. So that is what you need to have your exit planned before you enter. If it's for retirement planning, well and good. That's an exit. But in retirement planning, what do you want? You want regular cash flows at that month, right? So somewhere you have to stop that investment cycle and go down to an SWP or withdrawal cycle. Fine. But do not make any investment just like that. Because only then you will know how and when to exit that investment. So this is the second golden rule about it. The third is avoid unnecessary churn in your portfolio, saying I made a wrong call there. By and large, things work out. But if you're doing so, there is one particular, behavioral thing which you should protect yourself, is that you should delink your selling decision from your buying decision. Because many people buy at 100 and it's gone to 60 now and then say, oh, should I go? The decision on when the stock price is 60 to whether to sell it or not is, can it grow from 60 to 40? Then I sell. Can it go from 60 to 80? Then I don't sell. It has nothing to do that you bought at 100, you're sitting on a 40 rupees notional loss. Lots of people get confused. They carry that hangover. There is a behavioral bias there. There's a word for a technical word, but I don't like to use technical words. All I'm saying is separate the selling decision from the buying decision. Take a decision as if this is today's decision. Forget whether you already made a profit, already made a loss. It's a sunk cost. Leave it in the waste paper basket. Right now you would say, I want to churn my portfolio. This sectoral fund, I bought this. Do you feel this sector within the next few years is going to do better or worse? If it's going to do worse, sell. If it's going to do better, don't sell. So I think if they use this, because as it is, I don't want them to churn too much. But yes, people do buy sectoral funds which go through cycles. So you have to take those calls. So I'm just giving that piece of advice to them. So from a retail investor, these are the three things, right? Buy when you're near lows, set a goal for every investment decision. And third is separate your selling decision from your buying decision. Don't let the original buying decision cloud the selling decision at all.
Okay, great, sir. Thanks for all the guidance over the last 1 hour. So there's one specific, wide sector we wanted to ask about, which is the
Hmm.
financial services sector. So just a
Hmm.
few, questions in our mind. Number one,
Hmm.
it hasn't performed as well in the last couple of cycles. So I
Hmm.
refer to private banks as well as public sector banks, which actually did well. And
Hmm.
also the various NBFCs, which have various sectors like microfinance, housing finance, affordable, gold. So the question is very simple. Uh, you know, Considering all the RBI measures that have come for liquidity easing, it seems that
Hmm.
NBFCs would stand to gain a lot compared to the
Hmm.
earlier liquidity cycle. But
Hmm.
again, PSU banks after their rally, what is the outlook? And private banks, of course, have been muted for some time. So your views
Hmm.
on these two, three sections within financial, banks.
So, so first of all, I'm very positive on the overall BFSI space. Okay, that's one point I want to make. Second point is you specifically asked me about the three sectors, which is private banks, public sector banks, and NBFCs, right? So, to me, uh, private sector banks and the larger NBFCs are essentially a play on retail because they are largely lenders in the retail space and the retail lending growth. And so the festival season boom and everything, most of this will be done on a zero cost EMI or a EMI basis purchases, which is where these people are at the forefront. And I think within that, you mentioned, gold financing companies. I think gold's rally has improved the margins of their existing lending tremendously. So their ability to take the existing gold already secured with them and go to a customer and try and cross market another additional loan. Because the value of the gold when you gave it originally to now, minimum 1 year it's 50% higher. So their ability to grow a loan book on an existing collateral that they already hold is phenomenal. And so I would say that my near-term outlook for all of these three is very positive because I see a strong growth in the loan book. The recent quarterly result numbers have also borne out what I said. The sector hasn't performed well for a different reason. It's because these private sector banks and all are big weights, are heavily FII owned, and are big weights in the MSCI India index. So, which is what they use as a benchmark when they invest. So, the consistent selling by the FIIs has had its impact on the larger bank and BFC space, right? So, I'm a believer that the tariff scene will get resolved and the FIIs will come sometime during the next year, definitely. So then these are going to get their automatic share of buying, not just from active fund managers taking a call, but from the passive fund inflows, which carry about 30 to 35% is just this banking sector, banking and financial service sector in that MSCI index. So they automatically get a lot of passive flow blind coming into them. So for me, from a next 1.5 year perspective, I am reasonably bullish on the larger NBC. Plus, I think for NBFCs, RBI has also allowed them to access international ECB borrowing. So provided they manage their forex exchange risk management well, that's another source of funding for them, which is to be augurs very well for them. So That's my view on the private sector banks. On public sector banks, there has been a very good rally, but I still there's a lot more room to run. And the reason for this is three, fourfold, right? So first one is that the consumption boom that's taking place, the PSU banks are not a large part of it. They are not there out at your Vijay sales and appliances or somewhere giving, EMI loans and all that. They're not a party in that. They just don't know that business. So they will probably not reflect all of that in their growth in the near term. But this consumption boom driven by the GST cut is going to ultimately lead to the top line growth in all consumption related sectors, which will lead to a capacity expansion need, because their existing capacities, they will all run out by in another 2 years' time because of the sharp boom that took place now. So they have to plan for their capacity expansion. Most of the private sector, especially consumer-related companies, besides which there's huge investment in power and all that also on the anvil. So when private capex get picked up, right, most of the execution in private capex is done by small cap companies in the market, non-small cap, micro cap listed in the market, but a huge bunch of MSME and SME companies which are nowhere near a capital market listing. But they all need financing and funding. And the only place that they can go to is a public sector bank, because a public sector bank has decades of experience in lending. Yes, they are high risk loans, so the NPA levels also come later and catch up. But the big thing is that one is that they have no other place to go other than to a money lender or use their own property to pledge it or take it. So public sector loan books will grow tremendously when the private capex cycle picks up. Second is because these people don't have a choice, those loans are at very high yields. 13 to 15% is what the MSME sector gets loans from the PSU bank. So the net interest margins of public sector banks also will be positively influenced, right? This is on the lending demand side. Now, what's happening on the capital adequacy side, as I think we mentioned a few minutes ago, that the government is considering increasing the foreigners' stake up to 49% in the public sector banks, number one. And number two is they are looking at, not officially confirmed, mergers. And like I said before, the mergers are not going to be small bank, weak bank with large bank. No, it's going to be two similar sized banks joining together to get them up in scale. And if you look at the numbers, even if you merge all the big top banks, we're still going to struggle to get somebody in the top 100 banks in the world. SBI is already there. Somewhere that's it. But we need to build that scale is very clear. I think the FM has also spoken about it amply. So when that happens, you'll have two good banks merging. So then the typical worry about a merger, that the good bank is being taken down by the bad bank, right? And the bad bank was anyway not any stock market darling or favorite of anybody, was not looked at favorably. But this time around is different, because I think two good quality banks of decent size will get merged to create international scale. So all of which means then their ability to lend, and government, if you noticed, has allowed now what? They've allowed project finance loans at much lesser capital adequacy requirements by the banks, because we do not have an IFCI, ICICI, IDBI project finance. So all the long-term project finance has to be done by domestic banks, and private sector banks are not great fans of that. So the burden or opportunity, whichever way you look at it, of project financing that private capex will also come to the public sector banking pack. Number one. Number two is the fact that, for loans against shares, they increase the limit to 1 crore. Now, when does it loan against shares? This is not what people think, that people borrow money from shares to put in the stock market. No, this is about promoters spreading their holdings to borrow to fill in the equity capital requirement of a project finance. So typical project finance is 70-30. 70 is lent by the lenders, 30 is to put equity. So what the promoters will do is take their share and pledge it with the bank and then put that money as their capital requirement for the new project, right? And especially why? Because if you remember, the income tax rule changed in 2017 or 18, right? Where they said that corporate taxes were reduced to 25%, but for a new manufacturing company being set up, the tax was only 15%. So the most of these companies, when they do their expansion capex, will do it through a subsidiary because that will then qualify for the 15% tax. But when that subsidiary comes, then to support for the capital equity, the promoter has to then pledge his shares and finance. So the bank limit for lending against shares has gone up from 25 lakhs to 1 crore for that. The third big change which happens, which is favoring the public sector banks, is the ability of banks to now finance mergers and acquisitions. They were not allowed. You'll be surprised to know. When the news came, a lot of people called me and said, say, as if banks can't already finance. No. Because what happens is, you are buying another company. What will you pledge? You can only pledge the shares of that company that you're buying, no? So the banks just couldn't finance, and as an end use, it was not allowed for banks to finance a merger or an acquisition by pledging the share of that company as a collateral. Now, in the latest RBI guidelines, what the governor announced, the banks will be allowed to finance mergers. Otherwise, that field was entirely in the investment banking, private NBFC space, that kind of a lending. Now, when that field opens up for banks, a lot of mergers and acquisitions, bank financing, and there again the public sector banks will be in the lead because they are comfortable with that project financing piece. So overall, I remain very bullish. A lot of rally has already happened there, so keep your expectations reasonable. But I'm overall very bullish about the growth of business and the growth of margins of public sector banks.
Perfect, sir. So, sir, one last question for the day, although already touched upon. So, what still shifts do you think will define the Indian capital markets over the next decade?
What shifts, asking? Please repeat. A lot of first.
Yeah, so I was asking what structural shifts do you think will define the Indian capital markets over the next one decade?
Over the next one decade. So I think that the debt capital markets are going to boom a lot because I think that's one space where we have lagged behind. We haven't. And I think that, for example, one solution to that has already been found is the REITs are now being given equity classification. So that will now show up as equity capital market expanding. But I see REITs as a big, huge market outlook space because it's the best way to finance real estate. Because in a REIT, you already launched, you have a tenant on board and you're getting a paper method of getting wealth. So I think this reclassification of REITs as equity will give a huge boost to the real estate lending market, and that will be counted as equity. But the reason I break it up as part of the debt capital market, the old REIT thing, that's a lending is actually a lending product, but it's now been classified as equity, so that itself should give a big boost. And so I see REITs as probably the fastest growing space within an overall capital market sectoral growth of the capital market entry. That's one thing which I see as a huge thing. Second is I see the continuing depth of the SEBI putting in more ring fencing and protecting the retail investor, but I still see that the retail investors participation in the Indian stock market will grow tremendously, and that will provide a depth and a liquidity way beyond the BSE or NSE 500 stocks. So I see the depth of our capital market significantly changing over the next decade, to the extent like a Russell 3000 index in the US, you could very well have an India BSE 2000 index, if not 3000. And so the depth of options for both mutual fund managers and everybody for a well-researched. So that's where I think the stockbroking community is also important in the context of the earlier discussion, because you need somebody to go and research those 2000 companies properly. AMCs can't do it on their own. So I see the depth of capital markets with retail participation, I think, tremendously increasing. That's the second aspect of it. The third is that, though what I said about the PSUs being the primary lenders and everything, I see increasingly project lending also being financed by the debt capital markets, which I think has not picked up to the extent. Internationally, if you see, banks are only arrangers of loans. Even if they originate it, they book it and distribute it. It's called OBD, originate, book, distribute. But in India, these corporate banks and everybody are still taking the loan. The passing on the loan, the depth of the secondary market, of the debt market, I think is not real picked up in India. So that's something which I see as a tremendous growth, because ultimately then that risk capital will find its right, because the bank is today dependent on CASA, but he's borrowing short term and lending long term. There's a huge mismatch technically happening there, which is not healthy for the markets. So ultimately, a corporate wants to do a project capex, he should be issuing a 5-year or a 7-year paper to which mutual funds and insurance companies others should subscribe. That development of the debt capital markets separately, I think is something that over the next decade, I'm sure we will achieve. Fourth part of it is, I think, the retail participation in the GSEC market. I think that will increase because increasingly people are looking for options beyond bank deposits, and people who are risk averse are hesitating to come into the equity related mutual funds, and debt mutual funds are still not well sold. That will improve, but I think that the retail GSEC, because governments people have intimate trust in the government of India. So I think the retailization of GSECs and people going and buying GSECs, right, is something that will tremendously improve. So the depth of our GSEC market also I see over the next decade as changing.
Thank you, sir. So we got one more speaker, sir, and last question. So Arvindji, you can unmute and ask your pointed question. Arvindji, you there?
He's still in a listener mode.
सर मेरी आवाज आ रही है सर?
हाँ जी, आ रही है अरविंद जी. हाँ, बताइए अरविंद जी.
सर नमस्कार, मैं अरविंद बोल रहा हूँ सर.
हाँ,
सर डिफेंस सेक्टर पे मैं अपना व्यू पूछना चाहता था सर.
तो डिफेंस सेक्टर में मेरा व्यू है कि 2-3 चीजें उसमें. एक कि जो पास्ट में डिफेंस में परफॉर्मेंस थे वो शायद फ्यूचर में उतना बड़ी परफॉर्मेंस नहीं रहेंगे. मैं कह रहा हूं कि डिफेंस इंडेक्स में देखें तो अभी भी 70-80% आपको पब्लिक सेक्टर डिफेंस कंपनी से शामिल है और उनमें भी रैली भी अच्छी हुई है. मगर आने वाले दिन प्राइवेट सेक्टर का होगा, क्योंकि वो न्यू एज वॉरफेयर का होगा, जैसे ड्रोन्स और यूएवीज और वैसे जो हमने इंडो पाक वॉर में हमने दिखा था हमारे क्षमता, वो अभी बहुत उभर के बहुत से प्राइवेट सेक्टर कंपनीज इनोवेटिव, ये सब आत्मनिर्भर भारत के प्रोग्राम का फल है और वो बूमिंग है. और अब वो खाली इंडिया की मॉडर्नाइजेशन ऑफ अवर डिफेंस फोर्सेस में काम नहीं, हाथ नहीं फैलाएगी, बट एक्सपोर्ट में उसका बहुत बढ़िया ग्रोथ होगा. मैं अभी भी देख रहा हूं कि बाकी एशियन कंट्रीज को छोड़े यूरोपियन कंट्रीज भी ये वाले चीजों के लिए हमारे पास ऑर्डर के लिए आने शुरू करे हैं. तो वो गवर्नमेंट की मॉडर्नाइजेशन तो एक तरफ उनको ग्रोथ दिलवाएगी, मगर एक्सपोर्ट का मेरा बहुत बड़ा इस न्यू एज कंपनी की ग्रोथ में दिख रहा हूं. तो मुझे डिफेंस सेक्टर की ओवरऑल बिजनेस ग्रोथ में मैं करीबन 20 से 25% पर एनएम का सीएजीआर दिख रहा हूं. और एक्सपोर्ट जैसे मैंने लास्ट देखा था करीबन 22,000 करोड़ की थी, वो इजीली 5 साल में 50,000 करोड़ तक दुगना हो सकता है. तो ओवरऑल ग्रोथ प्रोस्पेक्ट्स फॉर द डिफेंस बिजनेस बहुत बढ़िया है. खाली मेरी चीज है कि आने वाले दिन वो डिफेंस इंडेक्स में वो रिप्रेजेंट नहीं होता. तो डिफेंस को आपको खेलना है तो खाली निफ्टी डिफेंस इंडेक्स को खरीद के आपका पूरा काम नहीं होगा. मेरे ख्याल में आपको अगेन एक 20-25 कंपनी की पोर्टफोलियो अपने आप बनानी चाहिए, जिसमें आप शायद आधा इन पीएसयू डिफेंस कंपनियों की रखे, मगर आधा आप प्राइवेट सेक्टर के उभरते हुए कंपनियों में भी आप निवेश करें. तो ऐसी एक पोर्टफोलियो में. दूसरी बात मैं कहूंगा कि क्योंकि आज थोड़ी वैल्यूएशन ज्यादा दिख रही है मुझे, आप एसआईपी लीजिए, क्योंकि ये अभी महंगी है, फिर भी थोड़ी थोड़ी खरीदारी शुरू करेंगे, बट एक करेक्शन भी आएगा उसमें, क्योंकि सेक्टर रोटेशन की मैंने अपनी स्पीच में बात की थी कि जब अच्छे एक्सपोर्ट ओरिएंटेड सेक्टर सामने उभरते हैं तो म्यूचुअल फंड मैनेजर्स को भी कहीं पे प्रॉफिट बुक के उस सेक्टर को खरीदने के लिए कैश क्लियर करना होगा. तो उस चीज में दैट टाइम देयर विल बी सम कंसोलिडेशन इन द डिफेंस रिलेटेड स्पेस बिकॉज ऑफ द रैली. मगर अगर आप एसआईपी का रूट इस्तेमाल करते हैं तो तब भी आप थोड़ा थोड़ा उस गिरते हुए वक्त में भी खरीदते जाएंगे. तो वो एक स्टैगर्ड बाइंग अप्रोच को भी आपको रखना है. तो दो चीज, डाइवर्सिफाई कीजिए, आधा पोर्टफोलियो प्राइवेट सेक्टर में रखिए, दूसरी बात एसआईपी रखिए, और तीसरी बात ये एक लंबी अवधि वाली कहानी है. तो मेरे ख्याल में इन्वेस्ट करने के लिए आपको 7 से 10 साल की आउटलुक अगर रखेंगे तो आपको पूर्ण फायदा इसका मिल सकता है.
थैंक यू सर, थैंक यू सर, थैंक यू.
Thank you, Arvindji. Thank you. And for our audience, you will find multilingual videos of Sunil sir. So you'll find a lot in Hindi as well, and even in the regional languages. So definitely, I would request each one of you to connect to his handle, wherein time and again, whenever there is any media interaction or any session on financial literacy or market outlook, you get to find the link at your ease. So it would be easy for you after following to locate those links. So Sunil sir, thank you so much once again. It was really insightful, and you always, I agree to the fact that you break down things in a so lucid manner that even a first timer would be easily understanding the thing. So thank you for the value addition from today's session. Thank you so much, sir.
Thank you, Prince, and all the best to all of you. Thank you.
Thank you, sir. Thanks everyone for joining. I hope you guys enjoyed the session. Keep